Hi, my name is Gord Beal, and I'm a Chartered Professional Accountant with CPA Canada. I'm here to talk to you today about planning for your retirement. Certainly an issue that we, at various stages of our lives, think about more so than others. And most would agree it's probably the largest bill you'll ever face. Today's session is designed to be interactive, so I want you to take opportunities to ask questions if you see any come to your mind, and don't hesitate to put your hand up because I'd be happy to answer them. Otherwise, at the end of this session, we'll also have room for questions and answers. So let's get underway. So let's talk about what we're going to cover today. Initially, I'm going to take you through an introduction that talks about, in general terms, financial literacy. Then we're going to go into why you even need to plan for retirement, how much you'll need to save. We're going to look at some retirement saving strategies. And then we're going to cover some sources of retirement income. And then we'll look at what we've learned about retirement planning just before I take you through a few tools and resources that may help you in your retirement planning process. And then we'll finish off, as I mentioned before, with some questions and answers. So let's get started. First, I want to set the broad context of financial literacy in Canada and why Chartered Professional Accountants of Canada are interested in helping Canadians improve their understanding of financial matters. In 2009, Canada's Task Force on Financial Literacy was formed to provide recommendations to the Minister of Finance on a national strategy to strengthen the financial literacy of all Canadians. The recommendations were delivered to the Minister of Finance in a report entitled Canadians and Their Money. The task force defined financial literacy as the knowledge, skills, and confidence to make responsible financial decisions. Knowledge refers to an understanding of personal and broader financial matters. Skills refers to the ability to apply that financial knowledge in everyday life. The confidence comes from having the self-assurance to make important financial decisions. And responsible financial decisions refers to the ability of individuals to use the knowledge, skills, and confidence they have gained to make choices appropriate for their own circumstances. CPA Canada commissions research about Canada's level of financial literacy, and the results, consistent with recommendations from the Federal Task Force, were a wake-up call for all of us. Canadians need to improve their financial literacy and financial literacy skills. Most Canadians believe responsible money management is an important life skill, and planning for retirement is high on the list. As Chartered Professional Accountants, we know about money. Advising individuals and businesses about their money is what we do. CPA Canada and our members across the country are uniquely positioned to help with financial literacy, and we're taking a bold step in this by providing you with this presentation. Retirement planning is something that many of us have thought of as various stages, and certainly every generation retirement has been a consideration. But today, probably more so than ever, it's important because, frankly, we're all healthier than we used to be. People are living longer. As a result, well, we want more time after we've retired to actually enjoy what's left of life. What's interesting is that to enjoy life to the fullest and provide a cushion for those age-related expenses, we need to plan for what we're going to have in order to make the most of our retirement. We all, of course, are aware that CPP and OAS and other related government pensions are available, but frankly, and I'm sure you'll all understand why I'm saying this, they're just not going to be enough. In addition to this, there's an ongoing change in the financial landscape. Companies are converting their pension plans from defined benefit to defined contribution. And it's important, as you're making your decision for retirement, to understand exactly what that means to you. So financial decisions and financial literacy really does matter. So in planning for retirement, there are some pretty basic questions that all of us have to ask ourselves, and I'm suggesting you'll need to ask yourselves when going through the process. Fundamentally, how much do I need? How much do you need? How much do each of us need to retire? What level of retirement plan are we going to need to live comfortably? And in fact, even the word comfortably will probably be dependent on each of you individually. What financial obligations are you going to have to meet? Will you still have debt upon retirement, or will you be free of debt and you can just use whatever money you have to have some fun with? What lifestyle do you want to maintain? Do you want to maintain the lifestyle you've had leading up to retirement, or do you want to live better than you were living before retirement? And I guess the last one that's really important for me when I'm thinking of some of those really important questions is, I've got a bucket list of things that I want to do when I get past my working years, and will you have enough money to actually get to those? Some of the other factors to consider is, when do you expect to retire? For some, they might be able to retire at 55. That ain't the case for me, that's for sure. For some people, they want to work until 70, 75. You know, there's different extremes to retirement. You have to make a personal decision of when that might be for you. What is your current net worth? What assets do you have? Do you have a house? Do you have a cottage? Do you have savings? That kind of wealth that might contribute to your retirement. Your health and life expectancy. Consider some of your family circumstances. What longevity is traditionally in your family. Your personal family situation, your spouse that you may need to take care of, children that may be relying on you in some way or another, whether it's for school or some other means. And something else to consider, and it's definitely worthwhile, is what kind of legacy might you want to leave behind, and what kind of contributions might you make to various charitable organizations. So there are a lot of things to consider when you begin planning your retirement. Now, I've taken you through a lot of things that you can personally think about as you're making your plans for retirement, and much of that will help you, but at the end of the day, some of you may still be at a bit of a loss as to what the circumstances are going to require for you in your retirement. And really, this is where it comes down to give some thought to engaging a personal financial planner in this, because they have the expertise to ask the questions that maybe you haven't thought of. They have the expertise to take you through the process. They have the expertise to help guide you in doing your personal planning for retirement. So in terms of how much you want to save, that's a really difficult question. And in fact, there is no right answer. It will vary from person to person. Each of us on an individual basis will probably come up with different answers. And that's okay. A guideline for you to follow is a 70% guideline. So what that means is, if you've been earning $70,000 for your career on average, let's say, and that's what you've become accustomed to living by, upon retirement, you might consider looking at 70% of that $70,000 or $49,000 as an amount that you'll require for ongoing income. But getting beyond that, what are your goals and dreams? Going back to what we were talking about before on the previous slide, what is it that you really are going to want to have upon retirement? Are you going to live in the city? Are you going to move to the country? I know I have friends who want to live in Toronto for half the year and they want to go to Florida for half the year. Do you want to buy a cottage? Are you going to live outside of the city the whole time and thereby live a little more simply than maybe you've lived so far? What are your interests? What kind of hobbies do you want to get involved in? Things that maybe you haven't had time for now that may be costly later on. And is there a legacy that you want to leave in all of this? And you can also even think, how much do you want to leave behind? Going back to the point that I brought up before about your children. Maybe there's a legacy that you want to leave for them, and something that you can leave behind to help their lives be a little easier afterwards. So really, when it comes down to it, there's a lot involved in this. And probably I would suggest this is the most difficult piece of the puzzle. So I think we have established that a certain retirement lifestyle is going to require a certain level of savings. So what I want to cover now is some ideas for some of those strategies regarding savings. First and foremost, develop and implement a strategy for savings. Some may start when they're 18. Wonderful. Others may wait till later. Your strategy will be dependent upon the stage of life you're at. You may find ways of increasing your income and lowering your expenses. As some of you may be thinking about in terms of the timing of your retirement, some will work longer, retire later. Some may, once they've retired, even consider working part-time into retirement. And work with a retirement planner on this process. Much of it you can do yourself. Some of it would be useful to be able to take the ideas from those planners in order to incorporate it into your own personal saving strategy. So as you can see, there are a variety of sources of retirement income. Anything from personal savings and investments, to government pension benefits, to employer pensions. We're going to cover a few of those in the slides ahead. A few examples from this slide include registered retirement savings plans, or RRSPs, your TFSAs, or the tax-free savings account, annuities, whereby you purchase from a financial institution an opportunity to get future payments. There are, of course, government pension benefits of CPP, QPP in the case of Quebec, and old age security. And on the employer pension side of things, defined benefit plans, defined contribution plans, just to name a few. The registered retirement savings plan is probably one of the most common tools for saving for retirement. Does anybody know what a notice of assessment is? I suspect many of you do, but just for those of you who don't. Every year, once you've filed your tax return, you'll get a form from Revenue Canada, and it summarizes a lot of information, but the important information as it relates to RSP is that it gives you your contribution limit. It will tell you how much you're able to contribute to RSPs. It's based on your last year's income and any unused contribution from prior years. Most financial institutions offer RSPs to individuals. Your first question is, how much can I contribute each year? And although you got the notice of assessment that said, here's how much you can contribute based on the tax side of things, how much you actually contribute will probably come down to your own personal financial situation. But at least the assessment notice tells you what your maximum is. We have an example for you to look at. Now, one of the benefits of RSPs is that when you put money in, it generates a tax savings. So in this example, we're assuming that the $10,000 is the contribution limit that has been identified on your notice of assessment, and that you have $10,000 to actually contribute to your RSP. We assume that you have a marginal tax rate of approximately 30%, well, actually 30% in the example, and that actually gives rise to a $3,000 tax savings when you make the contribution of $10,000. You may have heard advertisements on television to borrow some money for your RSP contribution. Certainly that's an option available to you, but keep in mind that the interest on that loan is not tax deductible. Probably a better strategy than borrowing money on that is to actually save throughout the year if you can. Set a little bit aside each month or each paycheck possibly. And this is where the idea of a TFSA, or your tax-free savings account, can come into effect. Because you can put the money into that, and there might be a bit of an earnings on that tax-free savings account. But as the account states, it's tax-free while it's in that account. Then you can use that money and make the contribution to your RSP. So your income tax savings that, as in this example, equates $3,000 should not be considered free money. When you get that tax refund, use it to pay down any debt you might have, or set it aside as your first installment towards your next year's RSP contribution. Worth noting with respect to RSPs, income earned within the RSP, such as interest, dividends, capital gains, they're all tax deferred. In other words, they're not taxable in that year. They're taxable later on at a point at which you might withdraw the cash from the RSP. When you withdraw money from your RSP, it's withdrawn and you pay tax at your highest marginal rate. So it's very important to think about when you're going to start withdrawing. If you withdraw it and you're at a very high marginal tax rate, that could cost you a lot of money. The theory behind RSP is to put the money in and leave it there until you get to your retirement years. There are, however, some options that have been made available through the tax laws. You can, for example, withdraw money from your RSP to purchase your first home. Or you can use it for education. If you do either of these things, it's considered a loan from your retirement savings plan. And so when you put money back in, it goes first to that debt and is not included as a deduction from your income tax. Just remember that there is a limit to how much you can take out, and it has to be repaid within the defined time frame, or you'll be taxed at your current and probably higher tax rate. Something to remember is that at the age of 71, any money remaining in your RSP needs to be transferred into your Registered Retirement Income Fund, or RIF, at which time any payments you withdraw from that become taxable income to you. Another great way to save for retirement is through a tax-free savings account, or TFSA. Now, TFSAs have only been around since 2009. And starting in 2013, if you're 18 years or older and a resident of Canada for income tax purposes, you can contribute up to $5,500. For the 4 years prior to that, the cap was at $5,000. This means that since 2009 until 2013, taxpayers could contribute $5,000 a year for the first 4 years, and for 2013 can contribute $5,500 a year. Similar to an RSP, any interest, dividends, or capital gains earned inside the TFSA account are not taxed. Unused contribution room can be carried forward and used at any time. So if you haven't been able to make contributions to your TFSA so far, you should have a fairly significant contribution limit available to you. In contrast to an RSP, contributions to a TFSA do not generate an income tax refund. But earnings in a TFSA are not taxable on withdrawal. So any earnings that you earn on the cash that you have in there are, as the name states, tax-free. A tax hint to consider with respect to TFSAs. You can contribute to a TFSA for your spouse or common law partner, or any young adult over the age of 18. Making such contributions will not affect your TFSA contribution room, and it allows your spouse or common law partner or young adult to maximize the amount of their personal tax-free savings. Now, looking at what's available from the government, let's take a look at the most common one of Canada Pension Plan, or CPP. Now, when you get to the point where you're looking to start collecting CPP, you do have to apply at least 6 months ahead. And you can apply to receive monthly payments as early as age 60. The average amount paid on CPP is about $512.38, as the example shows, on a monthly basis. Now, the longer you wait to collect CPP, the greater the pension. So if you wait beyond age 60, the pension will go up accordingly. A key change that is effective in January 2012 is that for ages 60 to 65, you must make CPP contributions based on employment income. So if after 60 you've already begun collecting your CPP, but you also have employment income, you actually have to continue your CPP contributions on that employment income. If you continue to earn employment income until 65, it would be better to wait on your collection of CPP until after you retire. Now let's talk about old age security and the guaranteed income supplement. Old age security must be applied for, similar to what we talked about regarding CPP. You must apply at least 6 months in advance of your first payment. However, proactive enrollment will be phased in between 2013 and 2016, where eligible seniors will no longer need to complete an application. Those eligible will be personally notified by mail. OAS is a monthly payment available to most Canadians aged 65 or older, based primarily on years of residency in Canada. However, as of 2012, the federal government introduced a gradual increase from 65 to 67. Those born after 1963 will receive benefits at 67 or older. Those born between 57 and 1963 should consult Service Canada's website for the specific eligibility years. The Guaranteed Income Supplement, or GIS, for the first payment, you must apply to get that. Filing an annual income tax return should be enough to continue receiving GIS payments. In other words, once you've made that first application, no further applications need to be done. The GIS provides additional money on top of the OAS to low-income seniors living in Canada. You must be receiving OAS and meet income requirements to receive Guaranteed Income Supplement. Somewhere around 40% of Canadians have an employer pension plan, and this will typically be a significant piece of the retirement plan. Examples of employer plans are defined benefit, defined contribution, deferred profit sharing, and group RSPs. It's probably worth defining the difference between defined benefit and defined contribution. In the case of a defined benefit, the employer has taken the responsibility to commit to a certain level of payment upon retirement. And that's usually based on a calculation that combines age, years of service. The defined contribution is where the employee makes a contribution into the pension plan towards whatever that retirement savings will be. Now, in the case of defined contribution, oftentimes employers will make a contribution on behalf of the employee. It's important to take advantage of the employer's plans in maximizing any employer matching contribution that's available. An example is that some employers will pay, say, $1 on every $3 that you contribute. So when you contribute that $3 into a plan, that extra dollar comes from the employer. Wherever possible, maximize those opportunities. It is important for you to understand your company's pension plan, so ask your human resources person if you need assistance. Probably worth remembering here again is that it's probably not going to be good enough to retire on your government pension plans of CPP and OAS. Other sources of income are going to be important. We've talked about your pension from the employer, we've talked about RSPs. There are also non-registered investments that will be very important as you plan for your retirement. And these kinds of savings are owned directly by you as the individuals. Some of the examples include equities, stocks in companies, bonds, mutual funds, segregated funds, annuities, shares even in private corporations, and of course, real property. An example, you might have a home or a cottage that you decide no longer to use after retirement, and that may become part of your retirement income. Include everything in your retirement plan income calculation. This will be important to really understand where you're going to be when that day comes that you're going to be retiring. So just worth noting on this before we move on is that segregated funds are mutual funds sold by insurance companies, and as you may recall, annuities are a guaranteed income stream purchased by an individual from a financial institution. So we're at the home stretch. What have we learned about retirement planning? Certainly we've covered a lot with this presentation, and hopefully you're feeling a little more informed about what you're going to do when it comes to your retirement planning. We looked at retirement as being the largest bill that you'll ever have to pay. You, as an individual, are a member of the healthiest and probably the longest living population ever. Government payments, probably not going to be enough to fund your retirement. How much wealth are you going to need? Well, that depends on your goals and dreams and requirements upon retirement. Remember, it's never too early to start retirement planning. Some of you have already started, and if you haven't, today's probably the day to start thinking about it. Consider using a retirement planner or your financial advisor, because they can provide expertise to augment your own personal decisions that you need to make in this. Utilize government tax deferrals, tax savings opportunities in terms of RSPs, your TFSAs. And remember that when it comes to government pension plans, you must apply for these ahead of time, your CPP, OAS, and GIS. Wherever you can, participate in your company pension plan. Oftentimes, when you're first joining a company, you're actually given the option as to whether or not you're going to be part of that plan. Certainly, it would be my recommendation that you make the decision to participate in those plans and speak with the HR person in your company to make sure you understand what the implications are of the different plans that are available. Maximize any company matching that your employer is willing to make. This is very good for you because it goes on top of whatever contribution you make. Non-registered investments, such as stocks, bonds, property, that sort of thing, should be part of your retirement plan. And remember to include all of your assets in your retirement income calculation. So we've covered a lot of ground, but now I'd like to ask you, are there any other ideas that we could add to this list to help with a retirement planning process? So to help you with your retirement planning, here are some good resources available that we recommend. Also, CPA Canada's book, A Canadian's Guide to Money Smart Living, can help you get started on your retirement planning. As well, visit www.financialdecisionsmatter.ca to download a free copy of CPA Canada's End-of-Life Guide, helping you plan for the final stages of life. We're at the time where I'm going to be turning it to you for any questions that you may have regarding today's presentation. And before I do, on behalf of Chartered Professional Accountants of Canada, I am pleased to have presented this session on retirement planning. And I hope it has helped you to improve your financial literacy. Thank you. So take a moment to read this slide, and if you have any questions, please feel free to ask me.